Welcome back to Market Newbie Trading Basics Part 2, Lesson number 7, Fundamental Analysis. In this part, we'll explain to you a few more technical terminologies and tools that you will find very useful in your trading. Before I start, I want to ask you to check out our website or subscribe to our channel on YouTube and learn about our silver, bronze, gold, and diamond path. We explained how stock market gains and losses are taxed in the last lecture. In this one, we will talk about fundamental analysis. Fundamental analysis is the investigation of the causes that affect the health of the economy, industry, sectors, and companies. The ultimate goal is to derive a forecast and benefit from future price movements. Fundamental analysis is absolutely necessary for stock market investment. It is so important that it's believed that you are gambling if you are not conducting fundamental analysis before picking any stocks. There are an endless number of investment strategies that are very different from each other, yet almost all use the fundamentals. Basically, there are three different study levels. They are the company level, the industry level, and the economy level. At the company level, fundamental analysis tests financial data, management, business concept, and competition. At the industry level, it examines supply and demand forces for the products offered. At the economy level, fundamental analysis focuses on economic data to assess the present and future growth of the economy. A fundamental analyst should combine all three study levels in order to forecast future stock prices more accurately. In this lecture, we would like to focus on the economy level. One of the most popular measures of a national's economy is gross domestic product, or GDP. GDP is a monetary value of the goods and services that a country produces in a specific year. This is an important statistic which indicates whether an economy is growing or contracting. As you can see, the US GDP has been growing in the past 10 years. The correlation of GDP growth with stock price rise of the 500 top US companies are evident, as it can be seen in the second graph here. Standard & Poor's indices shows how companies added value to the economy, which is another indicator of health of the country's economy. At the same time of recording this video, US has been going through a 10-year long bull market and its GDP is moving up year after year as well. Here is another set of graphs that shows how the decline and rise of a GDP correlates with S&P 500 in the US. In a bad economy, people and investors are in a panic mode. They rapidly take out their money and invest elsewhere, or they simply keep it in the bank until good days comes back again and invest. Less investment leads to less production, and as a result, GDP sinks. When it comes to GDP, we need to consider three other concepts. That is, GDP per capita, real GDP, and labor productivity. GDP per capita is the GDP number divided by the number of population. That makes it the best measurement of a country's standard of living. It tells you how prosperous a country feels to each of its citizens. Take a look at the first 50 prosperous countries in the market and get their historical GDP per capita. Then you can make a decision which country's stock market you should invest in. You can easily buy an ETF that tracks the economy's performance of that particular country. Real GDP has been adjusted for inflation and shows more realistic statistics. The concept productivity is related to real GDP. Labor productivity measures the hourly output of a country's economy. It shows the amount of real GDP produced by an hour of labor. In order to calculate a country's labor productivity, simply divide the total GDP by the total number of labor hours. For instance, if GDP is $10 trillion and the sum of man-hours of labor in that country is 100 billion, then the labor productivity is 10 trillion divided by 100 billion. This equals $100 per hour. Labor productivity shows how effective the goods and services in that country is produced at what price. Learning these concepts for the country you want to invest in is very crucial because this way you can wrap your head around the past performance and learn to predict the future behavior better in a broader sense. Another important concept that any fundamental analyst is aware of is the economic cycle. The economy usually follows a cyclic pattern of peaks and troughs. You can never have a never-ending prosperity or never-ending recession. Smart investors usually can rise from the burned economy due to devastating recessions by taking advantage of low prices and cheap workforce at the low time. The economy then gradually starts to go back and recover to prosperity. On the other hand, a long period of prosperity could lead to extravagant borrowing habits demonstrated by general public who may think that they can afford more things, jobs are steady, and dark days may never come back. Increasing consumer debts could lead to bankruptcies and domino effect to the entire society, at which point recession could hit and continue for a period of time. One important fact is that the trend of this sinusoidal graph is always towards more profit. That is, it has a positive slope. This is true in most developed and developing countries as population grows, production grows. As a result, more value or goods are added to the society. So, if you have a long-term view towards your investment, no matter when you buy, with enough patience, you will hit profit at some point. Now, the question is, will this trend line growth beat the inflation? The answer to this question is different from country to country. You need to look into the historical data of your own country and find out if the positive slope trend line is steep enough to beat the average national inflation over the past few decades. We summarize a few important things when performing economic fundamental analysis. First of all, know the economic cycle. Be very careful with the turns. What goes down eventually comes back up as long as you pick the right country, so be patient and never panic. Do not get affected by local drops. There are many corrections and local oscillations in a market trend. They are like weather versus climate. Weather changes all the time, but the climate generally follows a known pattern, unless, of course, a catastrophic phenomenon such as global warming happens. Third, read more about global and the national health of an economy. Try to learn and read more about economic terms such as GDP, GDP per capita, labor productivity, and the other important concepts. Lastly, we need to know that the long-term trend forecasts can be possible, but short-term peaks and valleys are difficult to predict. We need to keep this in mind and avoid making hasty decisions when we see a sudden or transient up or down in the market. Coming up next, we'll discuss fundamental analysis with a focus on the industry level. As always, for more educational materials, visit www.marketnewbie.com. Visit us on Facebook and Instagram. Again, leave your comment or question on these channels. The fundamental analysis is not over yet, so do move on to the next lecture. See you there.